There's a lot of content online with people claiming to know how institutions trade and so-called institutional levels or smart money concepts, which are factually just wrong. So I'm going to show you how to do it properly in this video. So if you've ever wondered how and where institutions place their orders, you will understand by the end of this video. So here we are on euro dollar. It's currently the 27th of February. These are the live markets at the moment. Intro of the video, there's a lot of people claiming to understand how institutions trade, what levels they look at, and it doesn't look like this. So institutions actually trade in a very, very simple manner, and I'm going to show you this throughout the video so you will have a very clear understanding by the end of the video. So essentially what institutions do, and this isn't accounting for high frequency algorithms or anything like that, we're talking about human input and real speculative trading. So they look at very simple support and resistance, but it's not how you might think. They will look at two things, essentially. They will look at, number one, where has the market rejected previously? And bear in mind, this isn't on small time frames. This is higher time frame stuff. So this is monthly, weekly, even daily levels. That's about as far as it goes. It can go into the H4, but only if there's something very serious there. So this, for example, I think it's very obvious. We've got a lot of people watching this. Do you think people managing hundreds of millions, if not billions in capital will sit and look at the euro dollar weekly time frame and not be paying attention to this level? Weekly time frame? They are. Obviously they are. They will be buying at this level and selling at this level. That's not uncommon. That's very, very normal. And this is why higher time frame analysis or a bird's eye view is so important. So you can see the same levels they're looking at because, again, it's very simple. They're not doing complex technical analysis. So we have this. First of all, we have very major key market levels, but then we've got the next layer, which is psychological levels or round numbers. Now, if you look very typically, now this isn't always the case, but very often, if you look at a round number in the market, you will see a reaction. So you can see here, actually, let me go down to the H4 just so I can show you it a bit more clearly. We can see here, we had the 0.5 level. Let me just change this to exactly on the 1.05. So you can see, very, very difficult to break through. Obviously, it's not pip perfect. The markets don't move tick perfect or pip perfect. There is always breaks and retests and all that sort of stuff, and false breakouts or whatever you want to call it is fine. But we have failed to break 105. Now, obviously, this market is fundamentally bearish, but this isn't a video about fundamentals or macro. This is purely technical levels and market structure. So we are looking at 105, and if you are bearish for whatever reason, whether you're following the daily trend or the fundamentals, again, it doesn't matter. You can look at these round numbers and say, okay, the market is very likely to use this as either some sort of resistance or maybe it will break and retest this level. Something is very likely to happen. Now we've got the same up here at 1.06. So you can see we did slightly break above. Again, it's never going to be 100% perfect. But 106 is a perfect example here where we have this sort of run to the downside. We come back up, slightly retest 106, use this as a resistance, and then continue down. Now, again, this happens and it repeats all the time. And I'm going to show you a great thing here. So these are real live bank trades. These are in the markets right now. There's, very simple. So their entries aren't anything overly special. You can see generally it's pretty close to a round number. I mean, you've got like 4188, so not round, but then you've got here a 4250, that's a round number. We've got 6540, round number. Now, of course, it can't always be a solid round number like 1.05 because obviously it depends where the market is. It might be quite far from that level, or it might just not be very likely given the current market conditions that level will get hit. So, of course, it's not always the case, but again, here you can see 157.6, round number. 63, round number. 160, round number. And the same thing with the take profits, they're round numbers. Now again, you might get it slightly off here at 58.65, but generally looking at this, it is mainly round numbers. And the same thing for stop losses, all round numbers. It's very simple, guys. Now, There is another layer to this. It's not just support resistance at key levels and psychological levels. You also get 200 moving averages. Now, moving averages are very, very commonly mistaken as a retail indicator. Moving averages don't work, blah, blah, blah. That's just factually false, and there's some images here to prove it. So first one, this was Citigroup. They went short on the euro pound some time ago because of a moving average and because of a resistance. And there's another image of a institution doing technical analysis using oscillators, moving averages, wedges, and all sorts of other technical bits. But you know what's not ever on a bank report? ICT or smart money concepts. You never see an FVG or a market structure shift or liquidity pool or anything like that, because that's just not how institutions trade. That doesn't work long term anyway. 200 moving average, again, this works because of the same reason as the other technical levels I showed you. It's a self-fulfilling prophecy. The indicator on its own doesn't do anything. No one, it has no influence over the market. But what does have influence is everyone looking at that indicator, everyone reacting off that indicator. I might buy because I assume you're going to buy, and you might buy because you assume someone else is going to buy. And that's how it works. If this market's moving up and we have a pullback to this 200 moving average, we get a herd. And again, it's not retail herd. This is an institutional herd. Enough money to really move markets buying off this level. And you can see it. Sure, again, we have small little breaks here, but again, that's completely normal. The markets are never perfect. So we have these small breaks and it's used as the support in this overall uptrend. So again, you can very easily look to buy off these levels. It's not rocket science. And obviously then we have a chop when we switch markets or switch conditions or trends, whatever you want to call it. But again, very simple sort of bounces off this 200 moving average. Even here, when we're in a downtrend, bounce off, bounce off. Now again, this is the daily time frame. So you could take this and you could say, okay, the market's just bounced off here on this daily. We've had a bearish engulfing daily candle. Maybe I want to go down to the 15 minutes or the 1 hour or the 4 hours. And just, you don't have to take this whole daily move. You could just take these 2 daily candles or even this sort of slight move down here and just take that on the H1 or the H4 and make a great return. And you've just traded using the overall market trend and a 200 moving average. Bearing in mind, guys, it's super retail. It doesn't work, but, it does work. So this hasn't been a super informative video. I know there's no complexities here. This is very, very simple. But the problem is I see so much misinformation on the internet about retail levels, retail indicators, how institutions trade, smart money concepts, blah, 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 blah. 99% of it is just factually wrong. And, if you don't believe me, fine. Keep trading the way you trade. Come back to me in 2 years and we'll see where you are. We'll see what your P&L is looking like. But trust me, what I'm telling you is the truth. I can guarantee it. Now, again, nothing complex here. So we've got psychological levels, so round numbers. We've got key levels on sort of monthly, weekly, daily timeframes. And we've got 200 moving average. That's it. That's all you really need. And then if you want to layer things on, you could use something like this, which is what I've got, which is the RSI. Now, again, this one isn't super retail or super institutional or anything. This is just what works for me. Now, again, I've already showed you that they do use oscillators like the RSI, like the MACD and the stochastics and things. It's not uncommon. It's very, very normal. So the settings I use, if anyone's interested, because this is custom settings. So I use a length of 6. I use an upper band of 80 and a lower band of 20. And this just allows me to filter out the extremes of the markets. So, for example, here, if I was wanting to buy, we've just broken out of this 200 Bollinger Band, followed by a very strong daily bullish engulfing candle. The RSI was oversold, it just came out. If I have some sort of macro reason, some fundamental reason to buy this market, this might be a great time. The entry looks good in technicals. Again, there's no super complex 1 minute time frame stuff here. This is just buying off the most basic things, but because it's so basic, it fulfills itself. It works because it's so simple. Sorry guys, the doorbell just went off, but that brings me to the end of the video. Again, I hope this has been some sort of value to some of you. It's been short, it's been sweet, but it's short and sweet because it's so simple and because it works. I don't need to sit here for 30 minutes or an hour going into super long things because there's just no need. you don't need that much time for me to explain this, or I don't even need that much time to explain this, because again, it's super simple. So guys, have a great one. Please like and subscribe if you haven't already. Again, I hope it's been some value to someone out there. So I will see you very, very soon.